Hey, what's up everybody? Welcome back to Entrepreneurial Edge. Today, we're talking about making our money work as hard as we do. We're going to unpack 10 powerful strategies that can help you transform your finances and start building real, lasting wealth. Whether you're just starting out or you're already on your financial journey, there's going to be something here for you. So, grab a notebook, get ready to take some notes, and let's get started on making your money work for you. Alright, the first strategy is changing your mindset about money. Instead of seeing it as something that's finite, start thinking of it as a renewable resource. When you invest your money wisely, it has the potential to grow exponentially, like planting a seed that grows into a tree. It's about understanding that money can be put to work for you, generating more money over time. This shift in perspective encourages you to think long-term and make strategic decisions with your money. Now that you're starting to see money as a renewable resource, let's talk about putting it to work. Think of your money like an employee. It needs a job to do. This could be anything from earning interest in a high-yield savings account to investing in the stock market or real estate. The key is to have your money constantly working for you, generating passive income or appreciating in value. One of the best ways to put your money to work is through real estate, but buying property can be expensive and a hassle. REITs, or real estate investment trusts, are like the low-maintenance, more affordable cousins of traditional real estate investing. Basically, REI. Ts are companies that own and operate income-producing real estate properties. When you invest in a REIT, you're buying shares of that company and get a piece of the rental income and property appreciation. The best part, you don't have to deal with tenants or any of the headaches that come with being a landlord. Not everyone is comfortable with high-risk investments, and that's okay. One of the smartest things you can do is pay off any high-interest debt you have. Think of it as a guaranteed return on your investment. Another great option is to max out your 401k contributions, especially if your employer offers a match. Other safe options include bond ladders, high-yield CDs, and high-yield savings accounts. Speaking of high-yield savings accounts, let's talk about parking your money. I'm not talking about just stuffing it under your mattress or leaving it in a checking account. When choosing a savings account, look for one with a competitive interest rate, no monthly fees, and FDIC insurance. Online banks often offer higher interest rates than traditional banks, so it's worth doing your research. Even though you're not actively investing this money, you still want it to be working for you in some capacity. Shop around and find the best rates available. This next strategy is all about leveraging what you have to get to where you want to be. You've probably heard of the story of the guy who traded a red paperclip for a house. Start by identifying something you have that's of value, whether it's a skill, a possession, or even just your time. Then find a way to trade that for something of greater value. The key is to be creative and always be on the lookout for opportunities to trade up. Now let's talk about a more unconventional investment strategy: peer-to-peer lending, or P2P lending platforms, connect borrowers directly with lenders, cutting out the middleman. This allows lenders to potentially earn higher returns and borrowers to access loans at lower interest rates. As a lender on a P2P platform, you can choose which borrowers to fund based on their creditworthiness. P2P lending can be a great option for those looking for alternative investments with the potential for higher yields. This next strategy is not for the faint of heart, but it can be incredibly rewarding if you play your cards right. It's called contrarian investing, and it means going against the grain and investing in assets that are currently out of favor with the market.
Think of it like buying a house when everyone else is selling.
If you do your research and believe in the long-term potential of an undervalued asset, investing against the tide can lead to significant returns. One of the best ways to build lasting wealth is to invest in assets that have the potential to appreciate in value over time. These are assets that generate income or become more valuable as time goes on, like real estate, stocks, or even collectibles. Real estate can provide rental income and appreciate in value over the long term. Stocks represent ownership in a company and have the potential to grow in value as the company grows. The key is to choose assets that you believe in and that have a track record of growth. The final strategy on our list is all about investing in the future. This could be anything from a friend's new business venture to a crowdfunding campaign for a product you think has potential. Investing in startups is inherently risky, but it can also be incredibly rewarding if you choose wisely. Not only do you have the potential to earn a significant return on your investment, but you're also supporting innovation and helping to bring new ideas to the world. So, there you have it, 10 powerful strategies to make your money work for you. Remember, building wealth is a marathon, not a sprint. It takes time, patience, and a willingness to learn and adapt. The most important thing is to take action and start putting these strategies into practice today. Thanks for watching. If you found these strategies helpful, don't forget to like, comment, and subscribe for more financial tips and advice. See you in the next video. What's up, everybody? Welcome back to Entrepreneurial Edge, the channel dedicated to helping you achieve financial freedom. Today we're diving deep into the wisdom of Benjamin Franklin, a man who understood not just money, but success in its many forms. Let's get started. Franklin was a big believer in moderation. He knew that going to extremes in any area of life could actually hold you back. Instead, find that sweet spot between work and rest, focus, and relaxation. This sustainable approach allows you to operate at your best for the long haul. Ever feel like your life is just chaos? Franklin understood the power of order. He believed that everything should have its place and time. When you're organized, you waste less time and energy on the little things, freeing yourself up to focus on what truly matters. This could mean organizing your workspace or planning your day the night before. We all have goals and dreams, but it's determination that sets the achievers apart. Franklin believed in setting clear goals and relentlessly pursuing them. It's about having that unwavering commitment to your vision, even when things get tough. Success isn't always linear. There will be setbacks and challenges, but it's your determination that will pull you through. Hard work, the foundation of lasting wealth. There's no substitute for good, old-fashioned hard work. Franklin, a self-made man, understood this better than most. He always emphasized focusing on the most important tasks first and putting in the hours. Building wealth isn't about get-rich-quick schemes, it's about consistently showing up and doing the work. Thrift. Spend less, save more, invest the rest. Thrift is the cornerstone of building wealth. Franklin believed in saving a significant portion of his income and investing it wisely. The key is to make your money work for you, not the other way around. Silence, the power of meaningful communication. Franklin believed in speaking only when it benefited himself or others. It's about being intentional with your words and using silence as a tool for reflection and observation. Sincerity, building trust in strong relationships. Sincerity is the foundation of any strong relationship. Franklin understood that being genuine and honest builds trust and respect. When you're sincere in your dealings, you create a positive ripple effect. Justice integrity is the name of the game. Justice, for Franklin, was about living a life of integrity. This means fulfilling your duties, keeping your word, and being someone others can rely on. Remember, your reputation is everything. Serenity, mastering your inner world. Life is full of ups and downs, but Franklin advocated for serenity. He believed in staying calm under pressure and focusing on solutions rather than problems. Cultivating inner peace is more important than ever. Routine, the power of a structured day. Franklin was a firm believer in the power of routine. A consistent routine eliminates decision fatigue and helps you prioritize tasks effectively. Double mornings hacking your day for maximum output. Franklin had 2 mornings in his day, allowing him to tackle important tasks when his mind was fresh. While it might not be practical for everyone, the principle behind it is powerful. Experiment with different work patterns to maximize your productivity. Prioritize important work. Eat that frog. By tackling your most challenging task first thing in the morning, you set the tone for a productive day and avoid procrastination. Attract wealth by changing yourself, the inward transformation. Franklin believed that wealth was about cultivating the right mindset and habits. He emphasized personal growth, continuous learning, and developing strong character traits. By focusing on self-improvement, you naturally attract opportunities. Save and invest, the power of compounding. Franklin was a strong advocate for saving and investing. He understood the power of compounding. Money invested over time creates a snowball effect. Diligence and persistence. Never give up on your dreams. Building wealth is a marathon, not a sprint. There will be obstacles and setbacks, but Franklin's life is a testament to the power of never giving up. It's about learning from your mistakes and always pushing forward. That's it for today's video. Remember, building wealth is about more than just money. It's about living a life of purpose and integrity. If you found this video valuable, please give it a thumbs up and share it with your friends. Don't forget to subscribe to Entrepreneurial Edge for more tips on achieving financial freedom. See you in the next one. Hey everyone, it's your friend from Entrepreneurial Edge. Listen, I know times are crazy right now. That's why today we're talking about how to recession-proof your portfolio. We're diving deep into 15 investments that not only weather the storm but can actually thrive when times get tough. So if you're ready to protect your hard-earned money and come out ahead, smash that like button, hit subscribe, and let's get started. Let's be real, no matter what the economy throws our way, people still need toothpaste, right? That's why investing in consumer staples is like investing in certainty. Think about it. Even in a recession, people aren't going to stop brushing their teeth or grabbing a soda. These are the products that are ingrained in our daily routines. So when you're looking for stability, remember, the essentials always win. The internet is as essential as electricity, and that's not changing soon. Telecom companies keep us connected and are sitting on a goldmine, especially with remote work rising. Companies are ditching office spaces and going remote. They need rock-solid internet and phone connectivity. Telecom provides essential services for businesses and individuals. This demand makes telecom a smart, recession-resistant play. When wallets tighten, people still crave those comfort foods. But instead of fancy restaurants, they're heading straight to affordable fast food chains. These chains thrive during recessions because they become the go-to option for budget-conscious consumers. This consistent demand, even during economic downturns, makes cheap fast food a surprisingly resilient investment. No matter what's happening, people need to eat. When times get tough, they shop smart. Discount grocery stores come in. They offer unbeatable prices on essentials. People prioritize food on the table. This need makes discount stores stable investments. The best investment you can make is in yourself. In a shaky job market, your skill set is your most valuable asset. Mastering your skills can mean thriving instead of just surviving. Learn a new programming language or become an expert in your field. The more valuable you are, the more indispensable to employers. Gold, a symbol of wealth and security for centuries. Gold and silver hedge against inflation and downturns. Investors flock to these assets, driving up value. A safety net for your portfolio. Gold tends to hold or increase value in uncertainty. It's a classic safe haven for a reason. The world runs on technology. From the smartphones in our pockets to the software powering businesses, tech is everywhere. Companies like Google and Amazon have become integral parts of our lives, and their dominance isn't fading, even during recessions. In fact, recessions can actually be a breeding ground for innovation in the tech space. That's where innovative tech solutions come in, creating opportunities for new startups and established giants alike. No matter what the economy is doing, people still need their medications. Pharmaceutical companies, especially those involved in essential drug production and retail, like CVS and Walgreens, see consistent demand, regardless of economic conditions. The pandemic highlighted the importance of this sector. People are prioritizing their health, making pharmaceutical stocks a potentially stable investment, even during recessions. Electricity, water, gas, these aren't luxuries, they're necessities. And the companies that provide these essential services, your utility companies, are in a uniquely stable position. People need these services regardless of the economic climate. This consistent demand makes utility stocks incredibly resilient. When the stock market is a roller coaster, the ultra-wealthy look for alternative investments, and nothing says safe haven like a Picasso or a Monet. Blue-chip art, those masterpieces created by the most renowned artists, has a history of holding its value, even during economic downturns. Art is a tangible asset with inherent cultural value. During recessions, blue-chip art can act as a store of wealth, attracting collectors and investors seeking a stable place to park their money. Some things in life are constant. Homes need repairs, kids need daycare, and unfortunately, people pass away. These are the realities of life, and they create a constant demand for certain essential services. We're talking about evergreen businesses, the home improvement companies, the daycare centers, the funeral homes. People might postpone a vacation, but they'll always prioritize fixing a leaky roof or ensuring their child's well-being. From the food we eat to the clothes we wear, commodities are the building blocks of the global economy. And some commodities like wheat, corn, and cotton are considered necessities. They're the raw materials used in essential industries, and that makes them less susceptible to the whims of economic cycles. This constant demand for essential commodities can make them a surprisingly stable investment. Life insurance isn't just about protecting your loved ones, it can also be a powerful tool for building wealth. Policies the wealthy use create tax-free income and safeguard assets. They offer death benefit protection and cash value growth, providing security even during market downturns. It's a way to create a lasting legacy regardless of the economy. Hedge funds. They have a reputation, right? And not always a good one. But here's the thing. Hedge funds are designed to make money in any market, even during recessions. How? By using complex strategies to hedge their bets. They might bet against the market, profiting when things go down, or use leverage to amplify returns. For experienced investors looking to potentially profit from market downturns, hedge funds can be a tool to consider. When businesses face economic headwinds, they cut costs and increase efficiency. Automation solutions like robotics or AI benefit during recessions. Replacing human workers with machines might sound harsh, but it's a reality. As companies streamline operations and reduce labor costs, demand for automation increases. Investing in these companies could be smart. So, there you have it. 15 recession-proof investments to help you weather any economic storm. Remember, diversification is key. Don't put all your eggs in one basket. If you found this video helpful, give it a thumbs up, and don't forget to subscribe so you don't miss out on future videos. And as always, make sure to do your own research and consult with a financial advisor before making any investment decisions.
Welcome back to Entrepreneurial Edge. Today, we're diving deep into 15 powerful strategies to fast-track your journey to a 7-figure net worth. Whether you're just starting out or already have a solid foundation, these tips will give you an edge in the game of wealth building.
Now you might be thinking, what does healthy eating have to do with making $1 million? It has everything to do with it. Your body and mind are your most valuable assets. Foods like fatty fish, leafy greens, whole grains, and dark chocolate can boost brain power and energy. Eggs are packed with protein for building mental muscle. Treat your body like the high-performance machine it is for long-term success.
Now, let's talk about exercise. This is about consistency, people. Schedule time for your physical and mental well-being. Think about a morning run, a lunchtime bike ride, or swimming for a full-body workout. Don't underestimate the power of yoga for flexibility and focus. A healthy body equals a healthy mind, equals a healthy bank account.
Now let's talk about setbacks. You're going to encounter challenges and roadblocks. The difference between those who make it and those who don't is mental resilience. Start small, set achievable goals, and build confidence. Embrace failure as a learning opportunity. It's how you bounce back that defines you. Never stop learning, the key to unlocking your earning potential. In business and finance, the learning never stops. Read books, listen to podcasts, take online courses, stay ahead of the curve. The more you know, the more valuable you become. Knowledge is power, and in this case, power translates to wealth.
Track your finances. The foundation of financial freedom. You cannot achieve financial freedom if you don't know where your money is going. Tracking your finances is non-negotiable. Keep detailed records of your income, expenses, and investments. Gain clarity to make informed decisions about your money. What gets measured gets managed. Good debt versus bad debt. Using leverage to build wealth. Not all debt is created equal. Good debt is an investment in your future, like education or real estate. Bad debt drains your income without providing any real return. Use good debt strategically to build wealth while aggressively paying down bad debt. Check out the debt snowball or debt avalanche methods. Debt can be a powerful tool when used correctly.
Location plays a huge role in your financial picture. Consider living in places with high earning potential but a low cost of living. Lower taxes and more affordable housing mean more money to invest and grow. Strategically position yourself for financial success.
Be smart about taxes. Maximize your deductions and choose the right tax filing status. Take advantage of tax-advantaged accounts for your investments. Legally minimize your tax liability to keep more of your hard-earned money.
Diversify your income streams. Side hustles are key. What skills can you monetize? Freelancing, graphic design, or creating online courses. Share your expertise, help others, and generate passive income. It's a win-win-win. Diversifying income accelerates your journey to $1 million. Learn to code, unlocking high-earning opportunities in the digital age. Coding skills are in high demand. Whether you want to become a software engineer or start your own tech company, coding opens up high-earning opportunities. Tons of free resources are available online. Start small, be consistent, and you'll be amazed at what you can achieve.
From employee to expert, building a lucrative consulting business. Leverage your experience and expertise to help others. Low startup costs, a strong network, and problem-solving skills can build your consulting empire.
Real estate investment building wealth. One property at a time. Real estate is a powerful wealth building tool. It can appreciate in value and generate passive income. Start small, maybe with a duplex or a small apartment building. Learn the ropes and build your portfolio over time. Real estate empires aren't built in a day.
A stock market investment growing your wealth through the power of the market. The stock market is accessible for growing wealth long-term. Start with index funds or ETFs to diversify investments. Investing in the stock market is a marathon, not a sprint. Be patient, stay informed, and watch your wealth grow. Compound interest, the eighth wonder of the world. Compound interest is the snowball effect of investing. Start early and be consistent. The earlier you start, the more time your money has to grow.
Retirement accounts. Maximizing savings and minimizing taxes. Start planning and saving for retirement early. Use tax-advantaged retirement accounts like 401(k)s and Roth IRAs. Contribute the maximum amount allowed each year and take advantage of employer matching programs.
Your journey to financial freedom starts now. 15 powerful strategies to accelerate your journey to $1 million. Keep hustling, keep learning, and keep building your empire.
Welcome back to Entrepreneurial Edge. Today we're diving into the minds of the wealthy, uncovering what they avoid to achieve financial success. We're talking about the habits, mindsets, and strategies that set them apart. From financial giants like Robert Kiyosaki and Warren Buffett, we'll explore key things the rich avoid. Make sure to like this video and subscribe for more insights on financial success. The first thing the rich avoid is a poverty mindset. It's about how they think about money. Robert Kiyosaki says the rich don't say, "I can't afford that." Instead, they ask, "How can I afford that?" This shift opens up possibilities. The rich cultivate a positive money mindset. Change your mindset, and you'll see new opportunities. The rich avoid financial illiteracy. They invest time in learning about personal finance and wealth building. Kiyosaki emphasizes keeping money and making it work for you. Knowledge is power, especially in finances. The rich focus on acquiring assets, things that put money in their pockets. Think real estate, stocks, businesses, things that generate income or appreciate in value. They avoid accumulating liabilities, things that take money out of their pockets. Instead, they focus on good debt, like a mortgage on a rental property. The rich rarely rely on one income source. They diversify their income through investments, side businesses, and ventures. This boosts earnings and provides a safety net. Multiple streams ensure financial security. Andrew Carnegie believed in outworking the competition. But it wasn't just about working hard, it was about working smart. He valued efficiency, delegation, and continuous improvement. Success comes to those who strive for excellence. The rich set clear, specific financial goals. They don't just say, "I want to be rich." They define what rich means and set specific targets. Specific goals give them something to work towards and track. A goal without a plan is just a wish, so create a roadmap. The rich exceed expectations. They go above and beyond. This builds a reputation for excellence. They constantly innovate and add value. This commitment propels them towards their goals. Carnegie was known for his calculated risk-taking. He wasn't afraid to seize an opportunity. The rich weigh potential rewards against downsides. They make informed decisions. Fortune favors the bold, but it's about calculated risks. Warren Buffett is known for his frugal lifestyle. He advises evaluating purchases by considering work hours. This helps make more mindful spending decisions. The rich focus on value, not extravagance. Smart spending is about being mindful, not cheap. The rich don't let their money sit idle. They understand the power of compound interest. They educate themselves about investment opportunities. They consult with advisors and make informed decisions. Investing wisely makes your money work for you. Buffett is known for his long-term investment approach. He invests in companies he believes in for the long haul. Building wealth is a marathon, not a sprint. Focus on slow, steady growth over time. Patience and discipline are key to success. John D. Rockefeller believed in choosing a vocation that served a greater purpose. The rich find meaning and fulfillment in their endeavors. They're driven to make a difference and leave a legacy. This sense of purpose fuels their success. Rockefeller was a meticulous planner. He believed in having a clear plan and analyzing progress. The wealthy set goals, create strategies, and track results. Planning and analysis are crucial for financial success. Rockefeller valued integrity as a cornerstone of his business practices. They build strong relationships based on trust. A good reputation is essential for growth. The rich are strategic about debt. They avoid high-interest consumer debt. They prefer to save and pay in cash. Debt can be useful if managed wisely. They build a strong financial foundation. The rich understand the power of networking. They build relationships with mentors. They attend industry events. They seek opportunities to meet new people. Their network is their net worth. The wealthy never stop learning. They are lifelong learners, constantly seeking new knowledge and skills. They understand the world is constantly changing. Continuous learning is key to success. So there you have it, the 17 things the rich avoid. These principles offer a roadmap to financial success. Wealth requires patience, discipline, and learning. Incorporate these principles one step at a time. Thanks for watching Entrepreneurial Edge. Like and subscribe for more tips. See you in the next video. What's something people don't know about financial freedom? It's time to take control. Building wealth starts with you. You need a plan. You need to be in charge. Financial freedom doesn't happen by accident. It takes commitment. It takes discipline. Start today. Take control of your money. Don't let money control you. Break free from the paycheck to paycheck cycle. Stop worrying about bills. You can do this. It's time to build a better future. a future with financial security, a future where money works for you. For more financial tips, like the video and subscribe to Entrepreneurial Edge for more tips on achieving financial freedom. A budget is your roadmap to financial freedom. It tells your money where to go. No more guessing, no more overspending. Start by tracking your income and expenses. Where does your money go each month? Write it down, every dollar. Next, create spending categories. Housing, food, transportation, be specific. Set limits for each category, stick to your budget. This takes discipline, but it's the key to financial success. You can do it. Stop estimating your finances. Get it on paper. A written budget gives you clarity. It eliminates financial surprises. When you write it down, you see it clearly. You identify areas to cut back. You find money you didn't know you had. A written budget keeps you accountable. It helps you stay focused on your goals. No more impulse purchases. No more buyer's remorse. Take control with a written budget. It's your secret weapon to financial freedom. Start today. Life throws curveballs. Be prepared with an emergency fund. This is your safety net. It covers unexpected expenses. Aim for 3 to 6 months of living expenses. Start small. Even $500 is better than nothing. Consistency is key. An emergency fund provides peace of mind. It prevents you from going into debt when unexpected costs arise. Car repairs, medical bills, job loss, be ready. Don't wait for an emergency to happen. Start building your emergency fund today. It's your financial security blanket. Conquering the debt monster: strategies for financial freedom. Debt is a burden. It steals your income and your peace of mind. It can feel like a never-ending cycle, trapping you in a web of financial stress and anxiety. But remember, every problem has a solution. But you can break free. You can conquer the debt monster. It starts with a plan and a commitment to change. Imagine the relief and joy of living debt-free. There are two powerful methods: the snowball method and the avalanche method. Both have their unique advantages and can be tailored to fit your personal financial situation. Both work. Choose the one that motivates you. The key is to stay consistent and focused on your goal. The snowball method. List your debts, smallest to largest. This method gives you quick wins, boosting your confidence and momentum. Attack the smallest debt first. Make extra payments whenever possible to speed up the process. Once it's gone, roll that payment to the next smallest. This creates a snowball effect, gradually eliminating all your debts. The avalanche method. Target the debt with the highest interest rate first. This method saves you the most money in the long run by reducing the amount of interest you pay. This saves you money on interest charges. Over time, you'll see significant savings which can be redirected towards other financial goals. Whichever method you choose, be relentless. Stay disciplined and keep your eyes on the prize. Pay more than the minimum. Celebrate your victories no matter how small. Each step forward is a step closer to financial freedom. You got this. Grow your wealth. The power of long-term investing. This section will guide you through the essential principles of building wealth over time. Investing is not just for the wealthy, it's for everyone. Regardless of your income level, you can start investing today and set yourself on a path to financial security. It's how you build wealth over time. Start now. The earlier you begin, the more time your investments have to grow and compound. Index funds are a great option for beginners. They offer a simple and effective way to invest in a broad range of stocks without needing to pick individual winners. They are diversified and low cost. This means you spread your risk across many companies and keep your expenses low, which can significantly boost your returns over time. They track the performance of a specific market index. By doing so, they provide a reliable way to mirror the market's overall performance, which historically trends upward. Don't try to time the market. Invest consistently over time. Regular automatic investments can help you avoid the pitfalls of market timing and take advantage of market dips. This is called dollar cost averaging. It reduces risk. By investing a fixed amount regularly, you buy more shares when prices are low and fewer when prices are high. Investing is a marathon, not a sprint. It's about staying the course and not getting distracted by short-term market fluctuations. Be patient, stay invested. The market will have ups and downs, but over the long term, it tends to grow. Let compound interest work its magic. The longer you stay invested, the more your money can grow exponentially. Your future self will thank you. By making smart investment choices today, you can enjoy a comfortable and secure financial future. Supercharge your savings tax-advantaged accounts explained. In this section, we will delve into the world of tax-advantaged accounts and how they can significantly enhance your savings strategy. Want to save on taxes and boost your retirement savings? Tax-advantaged accounts are designed to help you do just that. They offer unique benefits that can help you grow your wealth more efficiently. Take advantage of tax-advantaged accounts. These accounts provide tax benefits that can help you save more money over time, making them an essential part of any long-term financial plan. Two popular options: 401(k)s and Roth IRAs. Each of these accounts has its own set of rules and benefits, making them suitable for different financial situations and goals. A 401(k) is offered through your employer. Your contributions are tax-deferred, meaning you won't pay taxes on the money until you withdraw it in retirement. This can lower your taxable income now and help your savings grow faster. Some employers even match a portion of your contributions. Free money. Employer matches can significantly boost your retirement savings, so it's important to contribute enough to take full advantage of this benefit. A Roth IRA is an individual retirement account. Unlike a 401(k), you contribute after-tax dollars, but your withdrawals in retirement are tax-free. This can be a huge advantage if you expect to be in a higher tax bracket in the future. You contribute after-tax dollars, but your withdrawals in retirement are tax-free. This means you won't owe any taxes on the money you take out, allowing you to keep more of your hard-earned savings. Maximize your contributions to these accounts. The more you contribute, the more you can benefit from the tax advantages and the potential for growth over time. Consider setting up automatic contributions to make saving easier. It's a smart way to reduce your tax burden and secure your financial future. By taking full advantage of tax-advantaged accounts, you can build a more secure and prosperous retirement. Automate your way to wealth. Make saving effortless. Saving should be automatic. Set it and forget it. Most banks offer automatic transfers to your savings account. Choose a day after your paycheck arrives. Transfer a fixed amount or a percentage of your income. You won't even miss it. Automate your investments too. Set up recurring contributions to your investment accounts. Consistency is key to long-term success. Make saving a habit. Automate the process. It's the easiest way to reach your financial goals. Start small and watch your savings grow. Welcome to Entrepreneurial Edge. Today, we're diving deep into the minds of the ultra-wealthy. Not just how they invest or what cars they drive, but the core principles that got them there. And who better to learn from than Elon Musk, one of the most successful entrepreneurs of our time? We're breaking down the money principles and strategies that have helped him build his empire. And trust me, these aren't your typical get-rich-quick schemes. This is about understanding wealth from the perspective of someone who doesn't chase it, but attracts it. Make sure to like this video and subscribe to our channel for more insights into the minds of successful entrepreneurs. Now you might think someone like Elon Musk is obsessed with money, right? Wrong. He sees money as a tool, a resource to achieve bigger goals. Think about it. His passion isn't counting dollar bills, it's revolutionizing transportation with Tesla, pushing the boundaries of space exploration with SpaceX, and even dabbling in artificial intelligence with Neuralink. See, when you're laser-focused on solving big problems and creating value, the money just follows. It's a byproduct of that relentless pursuit of innovation. So instead of chasing dollars, ask yourself, what problems am I passionate about solving? What value can I bring to the world? That's where true wealth is built. One thing that sets Elon apart is his insatiable thirst for knowledge. The guy's a learning machine. From physics and engineering to design and technology, he's constantly absorbing information, always pushing the boundaries of his understanding. And this isn't just about reading a book a week, it's about diving deep into different fields, connecting seemingly unrelated ideas, and developing a truly unique perspective. This is what I call the T-shaped approach to learning. You go deep in one area, but you also branch out, gaining a broader understanding of the world. This kind of intellectual curiosity is fuel for innovation. It allows you to see opportunities where others see obstacles. Elon didn't start SpaceX knowing exactly how to build a rocket. He learned. He surrounded himself with experts, absorbed their knowledge like a sponge, and wasn't afraid to get his hands dirty. This willingness to learn new skills, even in areas outside your comfort zone, is crucial. Think about it. The more skills you have, the more problems you can solve, the more value you can create. Don't limit yourself to one field. Learn coding, master design, understand marketing. These are all tools in your arsenal, and you never know when they might come in handy. Make something people actually want. This one seems obvious, right? But you'd be surprised how many people miss the mark. Elon's success boils down to one simple thing: creating products and services that people actually want and need. Tesla is revolutionizing the electric car industry. SpaceX is making space travel more accessible. And even his early ventures like PayPal addressed real-world problems. The key takeaway here is to focus on providing real value. What can you offer that makes people's lives easier, better, or more enjoyable? When you find that sweet spot, success will follow. Unlock your flow state. Elon is notorious for his intense work ethic, often putting in 80 to 100-hour weeks. But it's not just about the hours, it's about the focus. He talks about entering a flow state where he's completely absorbed in his work, time seems to disappear, and he's operating at peak productivity. Now, I'm not saying you need to work yourself to the bone, but finding ways to minimize distractions and tap into that flow state is crucial. Whether it's blocking out time on your calendar, silencing your phone, or finding a quiet workspace, eliminating those productivity killers can make a world of difference. Question everything. Seriously, Elon doesn't just accept the status quo, he questions it. He breaks down problems to their most basic principles, challenging assumptions and finding innovative solutions. This first principles thinking is what allowed him to create reusable rockets at a fraction of the cost of traditional methods. Instead of thinking, "This is how it's always been done," ask yourself why. Is there a better way? Don't be afraid to challenge conventional wisdom and think outside the box. Treat time like gold, it's more valuable. Elon understands that time is the most valuable resource we have. You can always make more money, but you can't get more time. He's incredibly efficient with his schedule, maximizing every minute of his day. This means being ruthless with your priorities, learning to delegate tasks effectively, and saying no to anything that doesn't align with your goals. Remember, every minute you spend scrolling through social media or watching TV is time you could be investing in yourself, your business, or your passions. The Elon Musk mindset. So there you have it, the money principles that have helped propel Elon Musk to the top. Remember, it's not just about the money, it's about the mindset, the relentless pursuit of knowledge, the unwavering focus on creating value, and the understanding that time is your most precious asset. If you found these insights valuable, please give this video a thumbs up and subscribe to our channel for more content on successful entrepreneurs. Remember, by adopting these principles, you too can enhance your potential for success and financial independence.
Hey everyone, welcome back to Entrepreneurial Edge. Now imagine waking up every single month to $1,000 or more in dividends hitting your brokerage account. That's the power of building passive income streams, and it's something I'm incredibly passionate about. In today's video, I'm going to break down exactly how you can achieve $1,000 a month in dividends, even if you're starting from scratch. We'll be covering everything from understanding dividends to investing in high-yield dividend stocks and ETFs, so you can start building your path to financial freedom today. Make sure to like this video and subscribe to our channel for more financial tips and strategies that can help you build long-term wealth. Let's make sure we're all on the same page about what dividends are. Dividends are payments made by companies to their shareholders. When you buy stock, you're buying a piece of the company. As a part owner, you're entitled to a share of the profits. Dividends can provide a steady stream of passive income.
One of the biggest differences I've observed between how wealthy people and those struggling financially manage their money comes down to this. Wealthy people focus on acquiring assets, while those struggling often find themselves trapped in a cycle of acquiring liabilities. Now, what do I mean by that? Assets are things that put money in your pocket, things like dividend-paying stocks, rental properties, or businesses. On the other hand, liabilities are things that take money out of your pocket. Things like cars that depreciate in value, expensive vacations, or that daily latte habit that adds up more than you realize.
When it comes to investing in the stock market, there are two primary ways to make money. The first, and the one most people are familiar with, is appreciation. This simply means buying a stock at a lower price and selling it later at a higher price. It's the classic buy low, sell high strategy. While this can be a great way to grow your wealth, it does require timing the market, which can be tricky. The second way to profit from stocks is through dividends. As we discussed earlier, dividends are those regular payments you receive just for owning shares in a company. This provides you with a steady stream of passive income, regardless of whether the stock price goes up or down. Focus on large, established companies for dividend income. Now, it's important to note that not all companies pay dividends. Smaller, newer companies, especially in the tech sector, often reinvest all their profits back into the business to fuel growth, and that's perfectly fine. But when you're looking for consistent dividend income, you generally want to focus on larger, more established companies with a proven track record of profitability and dividend payments. Think companies like Pepsi, Coca-Cola, Johnson & Johnson, or even real estate investment trusts, or REITs. These companies have been around for decades, have weathered economic storms, and continue to generate profits and reward their shareholders with dividends.
The power of compounding. Reinvest your dividends. Compounding is a powerful tool for building wealth. Reinvesting dividends buys more shares, generating more dividends. For example, invest $1,000 with a 4% dividend. Earn $40 in the first year, reinvest it. Next year, earn dividends on $1,040. This snowball effect leads to exponential growth.
Example: investing in Pepsi, a dividend aristocrat. Let's look at a real-world example of how investing in dividend-paying stocks can help you achieve your financial goals. We'll use Pepsi, a company I've personally invested in, as an example. Pepsi is considered a dividend aristocrat, which means it has a long history of increasing its dividend payments year after year for at least 25 consecutive years. Let's say you start by investing $500 per month into Pepsi stock. Assuming a 4% annual dividend yield, reinvested quarterly, you would be on track to reach your goal of $1,000 per month in dividend income within roughly 12 years. Now, keep in mind that this is just an example, and actual returns may vary.
High-yield dividend stocks and ETFs, turbocharging your passive income. If you're looking to accelerate your path to $1,000 per month in dividends, another strategy you can consider is investing in high-yield dividend stocks or exchange-traded funds, also known as ETFs. High-yield dividend stocks, as the name suggests, are companies that pay out a higher percentage of their profits as dividends. Now, it's important to do your research and make sure the company's high dividend payout is sustainable. ETFs, on the other hand, offer a great way to diversify your portfolio and gain exposure to multiple high dividend stocks without having to pick individual companies yourself. Some popular dividend ETFs include VOM and VYO. Consistency and patience, the keys to dividend investing success. Now, before we wrap things up, I want to leave you with two of the most important principles when it comes to dividend investing, and really investing in general: consistency and patience. The key to building wealth through dividend investing is to consistently invest over time, reinvest those dividends, and let the power of compounding work its magic. It's not about getting rich quick. It's about making smart, informed decisions, staying disciplined, and letting your money work for you over the long term. Education and information. Empowering yourself as an investor. The last piece of advice I want to emphasize is the importance of education. The more you know about investing, the better equipped you'll be to make informed decisions about your money. Take the time to understand how dividends work, research the companies you're considering investing in, and stay updated on market trends. There are tons of resources available online, from reputable financial websites to educational YouTube channels like this one. The more knowledge you have, the more confident you'll be in your investment decisions.
Thanks for watching. I hope this video has given you a clear roadmap on how to achieve $1,000 per month in dividends, even if you're starting with nothing. Remember, The key is to consistently invest in quality dividend-paying companies or ETFs. Reinvest those dividends and let the power of compounding work its magic over time. If you found this video helpful, please give it a thumbs up and subscribe to our channel for more content on financial independence and passive income. And as always, remember to do your own research and consult with a financial advisor before making any investment decisions. Happy investing!
Welcome to Entrepreneurial Edge. In this video, we'll guide you through the basics of investing in the stock market. Don't forget to like and subscribe. Are you overwhelmed by the thought of investing in the stock market? Investing in the stock market can seem daunting, especially for beginners. The sheer volume of information and the complexity of financial jargon can be overwhelming. But let me tell you, it's one of the most powerful tools for building wealth over time. With the right knowledge and strategy, anyone can become a successful investor. It's about more than just making money. It's about achieving your financial dreams. Whether you want to travel the world, start a business, or simply enjoy a comfortable retirement, investing can help you reach those goals. Whether it's retiring comfortably, buying your dream home, or securing your children's education, investing can help you get there. These milestones are within reach if you plan and invest wisely. The key is to start early and stay invested for the long haul. The earlier you start, the more time your money has to grow through the power of compound interest. The stock market will have its ups and downs. That's just the nature of the beast. Market volatility can be unsettling, but it's important to stay the course and not let short-term fluctuations derail your long-term plans. But over the long term, the stock market has consistently trended upwards. Historical data shows that despite periodic downturns, the market has a strong upward trajectory over decades. This means that by investing consistently and patiently, you're giving your money the opportunity to grow significantly over time. Regular contributions, even small ones, can add up and make a big difference. Remember, investing is a marathon, not a sprint. It's about endurance and persistence, not quick wins. Think of it like planting a tree. You don't expect it to grow overnight. You carefully choose a spot, nurture it with water and sunlight, and patiently wait for it to grow. Similarly, you need to choose your investments wisely and give them time to mature. Over time, that small sapling can transform into a mighty oak, providing shade and beauty for years to come. Investing is similar. With patience and care, your investments can grow and provide financial security. You choose your investments carefully, nurture them with knowledge and patience, and over time, they have the potential to flourish and provide financial security for your future. Educate yourself, seek advice, and stay informed. So, are you ready to plant the seeds for your financial future? The journey may be long, but the rewards are worth it. Let's dive in and explore the exciting world of stock market investing together. With the right mindset and tools, you can achieve your financial dreams. Before we dive into the specifics of investing, let's talk about the different ways to earn money. Understanding these methods is the foundation of building a robust financial future. There are two primary methods: active income and passive income. Each plays a unique role in your financial journey. Understanding the difference is crucial for building long-term wealth. It helps you strategize and make informed decisions. Active income is the money you earn from actively working. This is the most common form of income for most people. This could be your salary, wages from a job, or income from a side hustle. Essentially, it's any money you earn by trading your time and skills. You trade your time and effort for a paycheck. The more hours you work, the more you earn. It's a vital part of life, but it has limitations. You only have so many hours in a day, and burnout is a real risk. Your earning potential is directly tied to the hours you work. This means there's a cap on how much you can make. Passive income, on the other hand, is money you earn without actively trading your time for it. It's about leveraging your existing resources. It's about putting your money to work for you. This can be through investments, rental properties, or other income-generating assets. Think of it as money flowing into your pockets while you sleep, travel, or even just enjoy your day. It's a powerful way to build wealth. Investing in the stock market is one of the most effective ways to generate passive income. Stocks can appreciate in value and pay dividends. Imagine owning a rental property. This is another excellent source of passive income. You collect rent each month without actively working for it. That's passive income. Over time, property values can also increase, adding to your wealth. Investing in dividend-paying stocks is similar. These stocks provide regular income through dividends. You receive regular payments from companies simply for owning their stock. It's a way to earn money without additional effort. Over time, those payments can add up and become a significant source of passive income. Reinvesting dividends can further accelerate your wealth growth. The beauty of passive income is that it provides financial freedom and flexibility. It allows you to live life on your terms. It allows you to achieve your financial goals faster and potentially retire earlier. Imagine having the freedom to pursue your passions without financial stress. It's not about getting rich quick, it's about making your money work smarter, not harder. Consistent, smart investments can yield substantial returns over time. By understanding the power of passive income and how investing can help you achieve it, you're taking a crucial step towards securing your financial future. This knowledge empowers you to make strategic decisions that can lead to lasting wealth and financial independence. Now let's demystify the concept of stock ownership. Understanding how stocks work is crucial for anyone looking to invest in the stock market. When you buy a stock, you're essentially buying a small piece of ownership in a publicly traded company. This means you own a fraction of the company and have a stake in its future. Think of it like buying a slice of a giant pizza, with each slice representing a share of stock. The more slices you own, the larger your share of the pizza, or in this case, the company. As a shareholder, you have the potential to benefit from the company's success. When the company performs well, the value of your shares can increase. There are two primary ways to profit from stock ownership: capital appreciation and dividends. Both methods can provide significant returns if managed wisely. Capital appreciation occurs when the value of the stock increases over time. This means the price you can sell your stock for is higher than the price you paid. You buy low, and hopefully, you sell high, pocketing the difference. This strategy requires patience and a good understanding of market trends. Dividends, on the other hand, are regular payments made by some companies to their shareholders, typically from their profits. These payments can provide a steady income stream. Imagine you buy stock in a company that manufactures electric cars. This industry is growing rapidly, and investing in it could be very profitable. If the company's cars become increasingly popular, demand for their stock could rise, driving up the stock price. This increase in demand can lead to significant capital appreciation. This is capital appreciation at work. Your investment grows as the company's stock price increases. Additionally, if the company decides to share its profits with shareholders, they might issue dividends, giving you a regular stream of passive income. This can be a great way to earn money without selling your shares. Owning stock also grants you certain rights as a shareholder, including the right to vote on important company matters. This means you have a say in how the company is run. You become part owner of the company with a vested interest in its success. This can be a rewarding experience, both financially and personally. It's a powerful feeling to know that your investments are helping companies grow and innovate. Your money is being used to develop new products and services. Remember, investing in the stock market involves risks. It's important to be aware of these risks and to invest wisely. The value of stocks can fluctuate, and there's no guarantee of profit. Market conditions can change rapidly, affecting stock prices. However, by understanding the basics of stock ownership and approaching investing with a long-term mindset, you can mitigate these risks and position yourself for potential financial success. Long-term investments often yield better returns and help you achieve your financial goals. Ready to embark on your investing adventure? The first step is to choose a brokerage account. A brokerage acts as your gateway to the stock market, allowing you to buy and sell stocks, bonds, and other investments. Think of it like your online investing hub. There are numerous reputable brokerages available, each with its own strengths and fee structures. Some popular options include Fidelity, Schwab, and Vanguard, to name a few. When selecting a brokerage, consider factors like trading fees, account minimums, research and educational resources, and customer support. Once you've opened your brokerage account, the next crucial step is to determine your investment strategy. This involves identifying your financial goals, risk tolerance, and time horizon. Are you investing for retirement in 20 years? Are you saving for a down payment on a house in 5 years? Your investment strategy should align with your specific circumstances and objectives. The key takeaway here is that there's no one-size-fits-all approach to investing. Your strategy should be as unique as your financial goals. Remember, investing isn't about getting rich quick. it's about making informed decisions that align with your long-term goals. By choosing the right brokerage and crafting a personalized investment strategy, you're setting yourself up for success in the exciting world of stock market investing. Thank you for watching Entrepreneurial Edge. If you found this video helpful, please like and subscribe to our channel for more content on investing and entrepreneurship. What's up, everybody, and welcome back to Entrepreneurial Edge. I'm so glad you're here. Today we're diving deep into the world of investing, and not just any investing, but how to invest like the Oracle of Omaha himself, Warren Buffett. These strategies can help you build wealth over time, just like Buffett did. Warren Buffett didn't start with millions. He began with a modest amount of capital, delivering newspapers and selling chewing gum. But what set him apart was his mindset. He wasn't just thinking about making a quick buck, he was thinking about long-term growth. He understood that even small amounts invested wisely could snowball into something significant over time. Don't be discouraged by small beginnings. Focus on making smart decisions, and the results will follow. Buffett's early ventures, like buying pinball machines and placing them in local businesses, taught him valuable lessons. So, even if you're starting small, think big. Buffett's investment strategy revolved around finding undervalued companies. He looked for businesses that were fundamentally strong but overlooked by the market. These were often companies facing temporary challenges or simply misunderstood by investors. This created opportunities for him to buy low and sell high. Think of it like finding a hidden gem at a garage sale. This requires research and patience, but the rewards can be substantial. He focused on companies with sustainable competitive advantages and strong management teams. This long-term perspective is key to his success. Buffett is a voracious reader and a meticulous researcher. He spends hours poring over financial statements, annual reports, and industry publications. He wants to understand a business inside and out before investing a single dollar. This dedication to research is crucial for any investor, especially those starting with limited capital. Every investment decision needs to be well-informed. Dig deep, understand the company's financials, its competitive landscape, and its long-term prospects. Buffett emphasizes understanding the moat around a business, its competitive advantage. The wider the moat, the more sustainable the business's profits. When Buffett finds a compelling investment opportunity, he's not afraid to go big. He's known for concentrating his investments in a select few companies that he believes in strongly. This concentrated approach allows him to maximize his returns. However, it's important to distinguish between boldness and recklessness. Buffett's boldness is always backed by thorough research and a deep understanding of the risks involved. He never gambles. He calculates. He understands that every investment carries some degree of risk, and he manages that risk carefully. Don't confuse his concentrated investments with throwing all your money at a single stock based on a hunch. One of the most powerful concepts in investing is compound interest. It's the idea that your returns generate their own returns, leading to exponential growth over time. Even small amounts, invested consistently and wisely, can grow significantly through the magic of compounding. Think of it like a snowball rolling down a hill. This is why it's so important to start investing early, even if you can only contribute small amounts. The earlier you start, the more time your money has to compound. Buffett has often referred to compound interest as the eighth wonder of the world. The longer your money compounds, the greater your potential returns. Let's look at some real-life examples of Buffett's investments. He invested heavily in Geico during a time when the company was facing significant challenges. Everyone else was selling. But Buffett saw an opportunity. He recognized the company's strong underlying business model and its potential for long-term growth. Similarly, he invested in American Express during the infamous salad oil scandal. Again, he went against the crowd, recognizing the inherent value of the brand and its long-term prospects. These examples illustrate Buffett's contrarian approach and his ability to identify undervalued opportunities during times of crisis. These bold moves paid off handsomely, contributing significantly to his long-term success. Buffett's investment philosophy can be summarized in a few key principles: patience, value investing, and a deep understanding of businesses. He's not interested in chasing trends or speculating on short-term market movements. He's focused on finding solid businesses that he can hold for the long term, allowing compound interest to work its magic. He often says, "Our favorite holding period is forever." This reflects his commitment to long-term investing and his belief in the power of compounding. He avoids emotional decision-making, focusing instead on rational analysis and a disciplined approach to investing. This disciplined approach allows him to navigate market fluctuations and achieve consistent long-term returns. That's it for today's video on investing like Warren Buffett. I hope you found these strategies helpful and inspiring. Remember, even small amounts of money, invested wisely, can grow significantly over time. Thanks for watching Entrepreneurial Edge. If you enjoyed this video and learned something new, don't forget to give it a thumbs up and hit that subscribe button for more valuable content. Building wealth is a marathon, not a sprint. See you in the next video. Hey everyone, welcome back to Entrepreneurial Edge. Today we're diving into Warren Buffett's brilliantly simple plan to retire wealthy, even if you're starting from scratch, no matter your age. If you're ready to unlock the secrets of retiring rich, hit that like button, subscribe to the channel for more game-changing financial strategies, and let's get started. Before diving into investment strategies, it's crucial to lay down a strong financial base. Warren Buffett, one of the most successful investors of all time, stresses the importance of building a rock-solid financial foundation. Think of it like this. You wouldn't build a house on shaky ground, right? A strong foundation is essential for stability. The same goes for your financial future. Without a solid base, everything else can crumble. The first step? Establish an emergency fund. Aim for at least a few $1,000s in an easily accessible savings account. This ensures you have quick access to funds when needed. This acts as your safety net, protecting you from going into debt when unexpected expenses pop up. It's your financial umbrella. Once you've got that emergency fund, tackle those pesky high-interest debts. They can drain your finances quickly. We're talking credit cards, payday loans, anything with crazy interest rates. These should be your next target. Focus on paying those off aggressively. The faster you eliminate them, the better. A great way to do this is the debt snowball method. List out all your debts from smallest to largest and attack the smallest one first. This method is highly effective. Once that's gone, roll that payment amount into the next smallest debt, and so on. This creates a powerful momentum. This builds momentum and keeps you motivated as you see those debts disappear one by one. The sense of accomplishment is incredibly rewarding. Now that you've got your financial foundation sorted, it's time to start building wealth through investing. This is where the real journey towards financial independence begins. Remember, it's not just about saving, it's about putting your money to work for you. Investing allows your money to grow exponentially over time. Warren Buffett loves the magic of compound interest. He often emphasizes its power in wealth creation. He calls it the eighth wonder of the world, and for good reason. Compound interest can turn small regular investments into substantial sums. It's like earning interest on your interest, and over time it can create serious wealth. The earlier you start, the more powerful it becomes. To ensure consistent growth, automation is key. Automating your investments removes the temptation to spend that money elsewhere. Set up automatic transfers from your checking account to your savings and investment accounts every month. This way, you pay yourself first. Treat your savings and investments like non-negotiable expenses. This mindset helps in maintaining financial discipline. A good rule of thumb is the 75/15/10 rule. 75% of your income goes towards expenses, 15% towards investments, and 10% towards savings. This balanced approach ensures you cover all bases. Once your emergency fund is full, shift that 10% into investments. This strategy accelerates your wealth building process. The goal is to get to a point where your investments generate enough passive income to cover your expenses. This is the essence of financial freedom. Warren Buffett is a huge fan of low-cost index funds, which are great for diversifying your portfolio and reducing risk. They offer a simple way to invest in a broad market. Don't be afraid to explore other investment avenues like real estate, commodities, or even starting your own business. Diversifying your investments can provide multiple streams of income and further secure your financial future. Cut back on unnecessary spending. Unnecessary spending can really sabotage your financial goals. It's easy to get caught up in wanting the latest gadgets, eating out, and upgrading our lifestyles, but those small purchases can add up and eat away at your money. One of the biggest culprits is buy now, pay later schemes, which often come with hidden fees and can lead to debt. Before you buy, ask yourself if you truly need it. It's not about depriving yourself. It's about being mindful of where your money is going. Focus on acquiring assets that put money back in your pocket, like investments or a side hustle. One trick to combat impulse purchases is the rule of 5. If you can't afford to buy 5 of something, you can't afford one. Sounds simple, right? But it's effective in curbing spending urges. Remember, it's about making smart choices to build wealth. Increase your income. While cutting back on spending is important, there's only so much you can cut back. Focus on increasing your income. Imagine the possibilities if you could increase the number of pennies coming in. This doesn't necessarily mean getting a second job. It could be as simple as asking for a raise, taking on freelance work, or turning a passion project into a side hustle. Constantly look for ways to increase your earning potential and diversify your income streams. The more money you make, the more you can invest, and the faster you can reach your financial goals. Resist the urge to fall into the trap of lifestyle inflation. Live below your means and invest the difference. The goal is to build wealth, not just look wealthy. Plan for the future. We've talked about building a financial foundation, investing, cutting back on spending, and increasing your income. But there's one more crucial piece: planning for the future. This isn't just about picking out the perfect beach house for your retirement. It's about being financially prepared for whatever life throws your way. Start by setting clear financial goals. Do you want to retire early, buy your dream home, travel the world, or perhaps ensure your children's education is fully funded? Write it down and break it into smaller, actionable steps. This makes your goals more manageable and achievable. Having a plan gives you direction and keeps you motivated. It's like having a roadmap to your financial future. Protect yourself and your wealth with life insurance, especially if you have a family that depends on your income. Make sure you have enough coverage to protect them financially. Review your policy regularly to ensure it meets your needs. Next, let's talk about estate planning. It's important to have your affairs in order, including creating a will, setting up a trust, and designating beneficiaries. This ensures your assets are distributed according to your wishes and minimizes stress for your loved ones. It's a final gift of peace of mind. Surround yourself with a team of trustworthy professionals, an honest attorney, a savvy accountant, and maybe even a financial advisor. Having the right people in your corner can make all the difference in protecting your wealth and making smart financial decisions. They can provide guidance, support, and expertise when you need it most. So there you have it. Warren Buffett's simple yet powerful plan to retire rich, even if you're starting with a low income and no savings. If you found these tips helpful, don't forget to give this video a thumbs up and subscribe to Entrepreneurial Edge for more insightful content on achieving financial independence. Until next time, keep hustling, stay focused, and I'll see you in the next video. Hey everyone, welcome back to Entrepreneurial Edge. Today we're diving deep into 8 of the best Vanguard ETFs that align with Warren Buffett's investment philosophy. We're talking about ETFs that you can buy and hold forever. So if you're ready to build a rock-solid investment portfolio for the long term, hit that like button, subscribe to the channel, and let's get started. Warren Buffett has consistently emphasized the power of simplicity and long-term thinking in investing. He's famously advocated for index funds, particularly those tracking the S&P 500, as a cornerstone for building wealth. An index fund aims to track the performance of a specific market index, like the S&P 500, which comprises 500 of the largest publicly traded U.S. companies. By investing in an S&P 500 index fund, you're essentially buying a tiny piece of all those companies. Buffett loves index funds because they eliminate the need to pick individual stocks, a strategy that often leads to emotional decisions and lower returns. And the best part? These index funds typically have extremely low fees, which means more of your money stays invested and working for you over the long run. So if you're looking for a way to build wealth steadily and efficiently, take it from Warren Buffett himself. Index funds are the way to go. Before we jump into the specific Vanguard ETFs, let's quickly break down what ETFs are. ETF stands for Exchange Traded Fund, and they're like a basket of stocks or bonds that you can buy and sell on a stock exchange. One of the biggest advantages of ETFs is their diversification. Instead of putting all your eggs in one basket, ETFs allow you to spread your risk across hundreds or even thousands of different assets. Vanguard is a leader in the ETF space, known for its low fees and investor-friendly approach. They offer a wide range of ETFs that track various market indexes, allowing you to build a diversified portfolio. Now let's dive into those 8 specific Vanguard ETFs that I think Warren Buffett would give a big thumbs up to. First up, we have the ETF that Warren Buffett himself has recommended time and time again, the Vanguard S&P 500 ETF, or VOO. This ETF tracks the performance of the S&P 500 index, made up of 500 of the largest and most influential companies in the US. VOO has an incredibly low expense ratio of just 0.03%. That means for every $10,000 you invest, you'll only pay $3 in annual fees. VOO has a solid track record of performance, with an average annual return of around 12.7% over the past 10 years. So if you're looking for a simple, low-cost way to get started with investing and track the overall performance of the US stock market, the Vanguard S&P 500 ETF is a fantastic option. It's a true buy-and-hold investment that can help you build wealth over the long term. Next, let's talk about the Vanguard Dividend Appreciation ETF, or VIG. Buffett loves companies that consistently pay dividends, and this ETF focuses on those dividend-paying powerhouses. VIG invests in companies with a proven track record of increasing their dividends year after year. Dividends can provide you with a steady stream of passive income, which you can reinvest to accelerate your wealth-building journey. VIG has an expense ratio of 0.06%. and has delivered an average annual return of around 11.23% over the past 10 years. It's a great way to add some stability and income potential to your portfolio. While the US stock market has performed well, it's important to remember there's a whole world of investment opportunities out there. The Vanguard FTSE All-World ex-US ETF, or VEU, provides exposure to international markets, excluding the US. By investing in companies outside of your home country, you can reduce your risk and tap into growth opportunities in different regions. VEU has an expense ratio of 0.07% and has delivered an average annual return of around 4.46% over the past 10 years. While that might seem low compared to some US-focused ETFs, global diversification is essential for building a resilient portfolio. So if you're looking to expand your investment horizons, the Vanguard FTSE All-World ex-US ETF is a great option. It's a simple and cost-effective way to add global diversification to your portfolio. A well-rounded portfolio also includes bonds, and the Vanguard Intermediate Term Bond ETF, or BIV, is a great option. This ETF invests in a diversified portfolio of investment-grade bonds with intermediate-term maturities. BIV currently has a dividend yield of around 3.27%, providing a more predictable income stream than stocks. With an ultra-low expense ratio of just 0.04%, BIV is a cost-effective way to add stability and income potential to your portfolio. It's a great way to balance out the potential volatility of stocks. Consider BIV to create a more diversified portfolio that can weather market storms. For socially responsible investors, let's talk about the Vanguard ESG US Stock ETF, or ESGV. This ETF focuses on companies that meet certain environmental, social, and governance (ESG) criteria. ESGV tracks a market cap-weighted index of large and mid-cap US stocks screened for ESG criteria. It excludes companies involved in controversial industries and prioritizes those with strong environmental and social track records. ESGV has outperformed the S&P 500 since its inception in 2018, with an average annual return of around 13.31%. With an expense ratio of just 0.09%, ESGV is a cost-effective way to invest in companies making a positive impact. It's a great way to align your portfolio with your values without sacrificing returns. Lastly, let's talk about the Vanguard Healthcare ETF, or VHT. Healthcare is a massive and growing industry, and this ETF allows you to tap into that growth potential. VHT tracks the performance of the MSCI US Investable Market Healthcare 25/50ths Index, including a diversified portfolio of healthcare companies. The aging global population increases the demand for healthcare products and services, making it an attractive long-term investment. VHT has delivered an average annual return of around 10.88% over the past 10 years. It's a diversified way to capitalize on the growth of the healthcare sector. So there you have it, folks. 8 fantastic Vanguard ETFs that align perfectly with Warren Buffett's investment philosophy. Remember, building wealth takes time, discipline, and a long-term perspective. These ETFs can be the foundation of a rock-solid portfolio that can help you achieve your financial goals. If you found this video helpful, don't forget to give it a thumbs up and subscribe to the channel for more videos on investing, personal finance, and building wealth. And as always, do your own research before making any investment decisions. Until next time, take care and stay financially savvy. Welcome to Entrepreneurial Edge. In today's video, we explore the journey of Warren Buffett from humble beginnings to becoming a billionaire. Stay tuned. Warren Buffett is a name synonymous with wealth and investing prowess. He is considered one of the most successful investors of all time. His journey, however, began far from the gleaming towers of Wall Street. From humble beginnings in Omaha, Nebraska, Buffett's story is one of relentless curiosity, a disciplined approach to investing, and an unwavering belief in the power of long-term value. Born in Omaha in 1930, Buffett displayed an early aptitude for numbers and business. He was fascinated by the stock market, making his first purchase at the age of 11. His entrepreneurial spirit was evident from a young age. He ran small businesses, delivering newspapers and selling chewing gum, showcasing a drive to create and accumulate wealth. His father, Howard Buffett, was a stockbroker and congressman who instilled in him the importance of financial prudence and ethical business practices. Despite his keen interest in business, Buffett was initially rejected by Harvard Business School. Undeterred, he enrolled at Columbia University after learning that Benjamin Graham, a renowned value investor and author of The Intelligent Investor, was a professor there. Under Graham's tutelage, Buffett honed his investment philosophy, focusing on identifying undervalued companies with strong fundamentals. This approach, known as value investing, became a cornerstone of his investment strategy. After graduating from Columbia, Buffett returned to Omaha and started his investment partnership, Buffett Partnership Limited. He adhered to Graham's principles, meticulously researching companies and acquiring stakes in those he believed were trading below their intrinsic value. His early investments reflected this approach, often focusing on overlooked or out-of-favor companies with strong underlying businesses. This strategy proved highly successful, generating impressive returns for his partners and solidifying his reputation as a shrewd investor. In 1965, Buffett acquired a controlling interest in Berkshire Hathaway, a struggling textile company. This acquisition marked a turning point in his career. Initially, Berkshire Hathaway was intended as a value investment. However, Buffett recognized its potential as a holding company for his growing portfolio. He gradually shifted the company's focus away from textiles and began acquiring businesses in various sectors, including insurance, energy, and consumer goods. Shifting gears from undervalued to high quality. While Buffett's early success was rooted in identifying undervalued companies, his investment approach evolved over time. He recognized the limitations of solely focusing on undervalued assets and began seeking out high-quality businesses with strong competitive advantages and capable management teams. This shift reflected a move towards a quality over quantity approach, emphasizing the importance of investing in businesses with durable earnings power and long-term growth potential. The insurance advantage fueling Berkshire's growth. A key element of Buffett's investment strategy was the acquisition of insurance companies. Insurance companies, with their large reserves of float premiums collected up front but paid out later, provided Berkshire Hathaway with a significant source of low-cost capital. This float became a powerful engine for growth, enabling Buffett to make larger and more substantial investments in other businesses. He viewed insurance operations not only as profitable enterprises but also as a means to fuel Berkshire's expansion into other sectors. The Berkshire Empire and Buffett's legacy. Under Buffett's leadership, Berkshire Hathaway transformed from a struggling textile manufacturer into a sprawling conglomerate with holdings in a wide range of industries. The company's portfolio includes iconic brands like Coca-Cola, American Express, and Geico, reflecting Buffett's preference for businesses with strong brand recognition and enduring consumer appeal. This long-term, value-oriented approach has yielded remarkable results, making Berkshire Hathaway one of the most valuable companies in the world and propelling Buffett to billionaire status. Warren Buffett's journey from a young boy fascinated by numbers to an investing legend is a testament to the power of discipline, patience, and a long-term perspective. His investment principles, rooted in value investing, a focus on quality businesses, and the strategic use of insurance float, have stood the test of time. Buffett's success is not merely measured in wealth, but also in his enduring influence on the world of investing. His unwavering commitment to ethical business practices and his philosophy of giving back through philanthropy have cemented his legacy as not just a brilliant investor, but also as a respected philanthropist. Thank you for watching Entrepreneurial Edge. If you enjoyed this video, please like and subscribe to our channel for more inspiring stories.
Hey everyone, welcome back to Entrepreneurial Edge. Today, we're diving into Warren Buffett's top 7 passive income cash flow assets that you can start using to build wealth. We're talking about the exact strategies he's used to amass a fortune. And the best part? These strategies aren't just for the ultra-wealthy. Anyone can implement them. Now, before we jump in, make sure you smash that like button and subscribe to the channel so you don't miss out on any of our future videos. Welcome to the journey of understanding the true purpose of investing. Warren Buffett once said, "The goal of investing is to lay out money now to get more money later." This simple yet profound statement encapsulates the essence of why we invest. He's talking about generating consistent cash flow over time, ensuring that your investments provide a steady stream of income. Most people think about investing in things that go up in value, like stocks or real estate, hoping for significant appreciation. But what's even more important is finding assets that pay you just for owning them. These are the true gems in the world of investing. When you have money coming in every month without lifting a finger, that's when you achieve true financial freedom. This is the ultimate goal for many investors. That's the beauty of passive income. It allows your money to work for you, even while you sleep. Imagine waking up every day knowing your investments are growing and generating income effortlessly. Nobody wants to work for their money forever. We all dream of having the freedom to do what we want, when we want, without being tied down to a job. Passive income is the key to unlocking financial freedom because it allows you to earn money with minimal ongoing effort. When you're not constantly stressed about money, you can focus on the things that truly matter to you, your passions, your relationships, and your overall well-being. One of Warren Buffett's favorite ways to generate passive income is through dividend investing. This strategy involves buying shares in companies that regularly pay dividends to their shareholders. When you own shares in a dividend-paying company, you're entitled to a portion of their profits just for being a shareholder. This means you earn money simply by holding on to your shares. Take Coca-Cola, for example. Buffett's been a longtime investor in Coca-Cola, and for good reason. The company has a strong brand and a reliable business model. They've been consistently paying dividends for decades, and those payments have been increasing year after year. This steady increase is a sign of a healthy, growing company. As the company grows and profits increase, so do your dividend payments. This means your passive income can grow over time without any additional effort on your part. And the best part is, you don't have to do anything. Just sit back, relax, and watch the money roll in. It's a truly hands-off way to build wealth. Now I know what you're thinking. Dividend payments seem pretty small. How can I build wealth with that? The key is to reinvest those dividends and let compound interest work its magic over time. Warren Buffett's a huge advocate for index funds, and for good reason. He believes they are one of the best ways for the average investor to grow their wealth over time. They're a simple, low-cost way to invest in the broader stock market and achieve long-term growth. By minimizing fees and maximizing diversification, index funds offer a straightforward path to financial success. Instead of trying to pick individual stocks, you're essentially buying a tiny piece of hundreds, if not thousands, of different companies. This approach eliminates the guesswork and reduces the risk associated with individual stock picking. This diversification spreads your risk and increases your chances of earning consistent returns over time. By holding a wide array of stocks, you are less vulnerable to the poor performance of any single company. One of Buffett's favorite index funds is the Vanguard S&P 500 ETF, ticker symbol VOO. This fund tracks the performance of the 500 largest companies in the U.S., providing broad exposure to the market. Over the past 30 years, the S&P 500 has generated an average annual return of around 10%. This impressive track record makes it a compelling choice for long-term investors looking to build wealth steadily. REITs real estate without the hassle. Real estate can be a fantastic investment, but it can also be a huge headache. That's where REITs, or real estate investment trusts, come in. REITs allow you to invest in real estate without all the hassle of owning property directly. By investing in REITs, you're essentially getting a slice of the rental income generated by those properties without having to deal with any of the headaches of being a landlord. It's a fantastic way to diversify your portfolio and generate passive income from the real estate market. Municipal bonds, tax-free income. If you're looking for a low-risk way to generate passive income, consider municipal bonds. These bonds are essentially loans that you make to a city, state, or local government, and in return, they pay you a fixed interest rate over a set period of time. The interest payments are often tax-free at the federal level, and sometimes even at the state and local levels, depending on where you live and where the bond is issued. Crowdfunding real estate, cutting out the middleman. Crowdfunding allows you to pool your money with other investors to invest directly in commercial real estate projects. It allows you to invest in larger, institutional-grade properties that were previously only accessible to wealthy individuals and institutions. By cutting out the middleman, crowdfunding platforms can often offer higher potential returns compared to traditional REITs. However, it's a compelling option for those looking to diversify their real estate holdings and potentially earn higher returns. So there you have it, Warren Buffett's top 7 passive income cash flow assets that can help you build wealth over time. Remember, building wealth is a marathon, not a sprint. It takes time, patience, and a solid strategy. Don't forget to give this video a thumbs up if you found it helpful, and be sure to subscribe to our channel for more videos on building wealth and achieving financial independence. Welcome back to Entrepreneurial Edge. I'm so excited for today's video because we're taking a peek behind the curtain into the world of billionaire finances. Ever wonder where the super rich keep their millions, their billions? It's not just stacks of cash hidden in a vault. Let's break it down and explore the fascinating strategies billionaires use to manage their wealth. Make sure you hit that like button and subscribe so you don't miss out on future deep dives into the world of finance. Billionaires keep surprisingly little of their wealth in liquid assets. We're talking cash in the bank, money market accounts, that sort of thing. On average, it's only around 1% of their total net worth. I know, it sounds crazy, right? Would you keep most of $1 billion in a checking account, earning minimal interest? Probably not. Instead, they use private wealth divisions within banks. These offer exclusive banking experiences for ultra-high net worth individuals. Dedicated wealth managers handle their accounts and investments. They get access to exclusive financial products and services. Imagine being greeted by name and whisked to a private office with a dedicated team. That's the level of service we're talking about. It's not just about luxury. These divisions offer essential security and discretion. So, while they might have a few million for expenses, most of their wealth is strategically invested. One of the golden rules of investing, whether you're working with a few $100s or a few billion, is diversification. Billionaires take this to heart, spreading their wealth across a vast array of investments to minimize risk and maximize returns. Take Jeff Bezos, for example. Sure, most of us know him as the founder of Amazon, but his investments go far beyond e-commerce. He's got his fingers in everything from cutting-edge biotechnology companies to real estate ventures to even niche businesses like glass votives. Why? Because diversification acts like a safety net. If one investment takes a hit, the others can cushion the blow. It protects their overall wealth and ensures that they're never putting all their eggs in one basket. Think of it as building a strong financial foundation. Just like you wouldn't build a house on a single pillar, billionaires don't rely on a single investment for their wealth. They diversify across different asset classes, industries, and even geographical locations to create a resilient portfolio that can weather economic storms. Real estate holdings. When you think of billionaire purchases, what comes to mind? Private jets? Yachts? Well, real estate is often high on the list, and I'm not just talking about a vacation home in Aspen. Billionaires invest in high-value properties across the globe, from sprawling estates to commercial skyscrapers. Take Mark Zuckerberg, for example. Sure, he founded Facebook, but he's also known for his significant real estate holdings. He's got properties in Hawaii, Lake Tahoe, and multiple estates in Silicon Valley. And then there's Jeff Bezos, who's become one of the largest landowners in the United States. He's got properties in New York City, a massive ranch in Texas, and even a sprawling estate in Washington, D.C. Real estate offers a tangible asset that can appreciate in value over time, providing a hedge against inflation. Plus, let's be honest, owning a piece of prime real estate in a coveted location has its perks. But it's not just about luxury. Billionaires often use real estate as a strategic investment, generating rental income, developing properties, or even holding onto land for future appreciation. It's a long-term play that can create generational wealth. Business investments. For many billionaires, their journey to wealth began with building a successful business. But they don't just stop there. They often reinvest their wealth back into the business world, becoming savvy angel investors or venture capitalists, funding the next generation of entrepreneurs. Bill Gates, for example, while known for Microsoft, also has substantial investments through the Bill and Melinda Gates Foundation. They've invested in a wide range of companies, from Berkshire Hathaway to Waste Management, Inc. These business investments often represent a significant portion of a billionaire's wealth, especially for those worth over $20 billion. It's a way to leverage their expertise, network, and resources to not only grow their own wealth, but also to support innovative ideas and shape the future of various industries. It's like a cycle of entrepreneurial energy. Billionaires who've experienced firsthand the challenges and rewards of building a business are uniquely positioned to identify promising startups and provide the capital and guidance they need to succeed. Alternative investments. Now let's step outside the box of traditional investments and talk about alternative assets. We're talking about things like gold, art, collectibles, even cryptocurrencies. Ray Dalio, the founder of the world's largest hedge fund, Bridgewater Associates, is a big proponent of gold. He suggests that 5 to 10% of an investor's portfolio should be allocated to gold as a hedge against economic instability. Why gold? Well, it's a tangible asset that's been considered a store of value for centuries. It's held its purchasing power even during times of economic turmoil, making it a popular choice for investors seeking to preserve their wealth. But billionaires are also known to dabble in art, rare collectibles, and even vintage cars. These assets can appreciate in value over time, and let's be honest, they add a certain level of prestige to a portfolio. And then there's the world of cryptocurrencies. While still a relatively new asset class, some billionaires have embraced cryptocurrencies like Bitcoin as a potential store of value and a hedge against inflation. So there you have it, a glimpse into how billionaires manage their money. It's a fascinating world of strategic investments, diversification, and a whole lot of financial savvy. Hopefully, this video has given you some insights into the world of wealth management, even if you're not quite in the billionaire category yet. If you enjoyed this video, don't forget to give it a thumbs up, subscribe to the channel for more content like this, and let me know in the comments what other financial topics you'd like me to cover. See you in the next one.